You know how I said at the beginning of the last chapter that you were going to love it, that there wasn't much calculation and it was an easy chapter? That's not true here. You're going to hate this chapter, but you really have to understand every slide in this chapter to do well on the exam and to do well on the next chapter. So take this one slow and easy. I'll do my best to make it as clear as I can, and you need to refer back to it as often as you need to. Remember, we talked about one of the functions of the Federal Reserve was to set the required reserve requirement, to set that ratio of the percentage of a bank's checkable deposits that they had to keep as required reserves. That's going to be important in this chapter. We create a fractional reserve system anytime a bank doesn't have 100% of our checkable deposits in their bank vault. And that's not the way our banking system works. So we have a fractional reserve system. We're going to start out talking about a single bank. That's confusing enough. And then we're going to take it to the entire banking system and look how a bank and their transactions can create money. You might want to take the time to read the Goldsmith section of your book. It probably is written there better than I can explain it. But it's the idea that before we had a well-established banking system, there were goldsmiths who would accept the deposits of people's gold in order to keep them safe. And in return for accepting the deposit of your gold, they would give you a receipt for the amount of gold that you had on deposit. So you could get your receipt for every ounce of gold or however you wanted to hold those receipts. Then when you wanted your gold back, you'd take your receipt back and the goldsmith would give you your gold. You paid him a fee for that service. But over time, those receipts began to be used as a medium of exchange. People would go to the general store or the saloon or wherever you were going, whatever you wanted to purchase. And instead of going to the goldsmith first to get to the gold and paying with gold, and you could do that if you wanted, but you could also simply give the store owner or the shop owner the receipts for gold that you had on deposit with the goldsmith, and then the store owner could present those receipts back to the goldsmith to get paid the gold. Or he could use it to buy the goods and services that he wanted. So you want to think about whether those paper receipts that the goldsmith was giving out were actually money. To do that, you have to look at those as compared to the three functions of money we talked about in the last chapter. The receipts were being presented for payment, so they were working for a medium of exchange. People were willing to give them. Shop owners were willing to accept them. They also stored well. You could come back and use them later, so they fit that unit. I'm sorry, let me try that again. That store of value function. And then lastly, you could understand, everybody understood what an ounce of gold was worth. So the receipts that represented a half ounce or a quarter ounce or a whole ounce of gold made goods and services be able to be valued in terms of that gold. I'm moving down under to characteristics now. When a bank loans money, we have to think about what happens. So we put our deposits of money with our bank. Our bank keeps a bit of that money, a fraction of that money, but it loans the rest out. The goldsmiths figured out that they could do that as well. They found that since people were using the receipts for a medium of exchange, that rarely did anybody come back to redeem the gold unless they were moving out of the territory. So the goldsmith got the idea that, well, I could loan some of this gold out and make more money for myself because the people aren't going to all come back and get it at the same time. So he began to make loans by simply writing receipts. He didn't actually give anybody gold. He just wrote people receipts for gold as a loan. And when they paid back those receipts for gold, they would bring the gold plus the interest that he was charging them. And he would be able to make a profit from making those loans. But once he issued receipts for more gold that he had in the vault, can you see that he set up a situation where if everybody did come back to get their gold at the same time, he wouldn't have enough gold to pay that off. So there's a situation set up for a bank panic, a goldsmith panic, or a bank panic when we have a fractional reserve system. That goldsmith actually created money when he wrote those extra receipts out for gold, more than he had in the vault, because that receipt then was being used to buy stuff at the various stores in town. So we can see that he literally created money when he was writing more receipts. But if you'll think a little broader, so does your friendly neighborhood banker every time they make a loan. Remember, what's the only two things in M1 money? We had currency and checkable deposits. When a banker makes a loan, they do so by putting money in your checking account. It doesn't come from anywhere. It doesn't reduce anybody else's checking account, and it doesn't reduce the currency, the dollar bills or whatever we have in our pocket. So when he makes a loan and he puts money in our checking account, the banker, that's the he I'm talking about, it creates money. It literally puts more money available for spending into the economy than we had before. But if everyone came back to get all of their money out of their checking accounts at the same time, there wouldn't be enough money in there. Have you ever seen the movie It's a Wonderful Life? That's exactly what happens in the beginning of that movie. It's a Christmas movie. If you haven't seen it, it's very good, but it's very old. That creates a bank panic if everybody tried to come back at the same time. We saw that happen in real life at the beginning of the Great Depression, and they declared banking holidays where they just closed all the bank until that panic could pass and we could figure out how we were going to get people the money out of their accounts that they were demanding. So all through this chapter, we're going to focus on really simplified balance sheets for a bank. If you've had your accounting classes, then you know the fundamental accounting equation is that assets equal liabilities plus net worth. So we know that there's an equal sign there. So on the balance sheet, whoops, I missed it here. Asset equals liabilities plus net worth. This is our fundamental accounting equation. So on the right side, we're going to have liabilities and net worth. On the left side, we're going to have assets, and both sides have to balance. That means if something happens to increase liabilities, we're either going to have a decrease in net worth to balance it, probably not. So if we're increasing or decreasing liabilities, we're probably increasing or decreasing assets because we have to keep those two sides in balance. So we're going to walk through all the necessary transactions to create a bank. Then we're going to let them accept deposits, and we're going to let them start making loans. We're going to let them buy government securities. There's a whole bunch of things the bank is going to be able to do, and we're going to need to be able to track that on the balance sheets. So we're going to start out with a brand new bank, and I'm not going to make any of this stuff up. It's right in your textbook. You can follow your textbook right along with these slides. So we're going to create a bank, the Wahoo Bank. That's the name of the bank. When we're creating this bank, we have to have some money. So the bank is going to sell stock shares to get cash to start their bank. So those stock shares represent the net worth. A lot of accounting classes call that owner's equity. It's just the value of the firm to the owners. So those stock shares is our net worth, and the cash that we sold those shares for is an asset. So we can use that cash to start building or opening our bank. So that's what this bank does. They use $240,000 of that cash to buy the property. That property has to include what? The land, the building, the equipment, everything we need to start our bank. So they've got their bank built for $240,000. They still have $10,000 in cash. Notice that still balances on both sides. We have $250,000 and $250,000, $250,000 on both sides. So now we're open. We're ready to start accepting deposits. So people come in and they come in with money and start opening their checking accounts and they deposit $100,000. So we've got $100,000 worth of cash from the deposits that were brought in. So we had $10,000 in cash, and then people brought in $100,000 to deposit. That gave us the $110,000 plus $240,000. That equals $350,000 on the asset side, and we can see that checkable deposits plus the stock share equals $350,000 on the liability side. You must stay in balance. When you're working your homework problems, you're going to see some that don't look like they're in balance because they don't give you all of the different accounts. What I really want you to stay focused on when I keep emphasizing you must be in balance is that if you change something on one side, you can't stop there. You've got to see what's going to balance it. It's either going to be an increase in asset and then an offsetting decrease in assets. Or if assets increase and there's not an offsetting decrease, then there must be an increase in liabilities on the other side. So just stay focused. Both sides of this balance sheet should balance, and if they don't give you all the accounts, you won't be able to total them up to be sure they balance. You'll just have to ensure that the transaction that you're making doesn't cause them to go out of balance. So now we have our bank, we have some checkable deposits, we have some cash. Banks don't tend to keep much cash at that bank. Banks get robbed. What they do instead is take that cash and deposit it with the Federal Reserve because the Federal Reserve doesn't get robbed. It's happened once in all of history, if I remember right. So remember we talked about one of the functions of the Federal Reserve was to set a required reserve ratio, that percentage of checkable deposits that the banks have to hold. They can hold it in cash in their vault, or they can hold it in the bank's checking account called a reserve account that's held at the Federal Reserve for each bank. The bank's checking account is called a reserve account, and the Federal Reserve holds those checking accounts. You will not use this formula to calculate the reserve ratio. It will always be given to you. It's set by the Federal Reserve, and it will always be given to you. So in real life, this is the percentages that required reserves that the Federal Reserve has set, broken down by the size of the bank. So if it's a little tiny bank with less than $16.3 million in deposits, that would be a little tiny bank. Currently, the Fed doesn't require them to keep any required reserves. That doesn't mean the bank doesn't keep required reserves, because of course they do, but the Fed doesn't require it. Their own board of directors is just given leeway to make those decisions. When you see the statutory limit, that's set by Congress. So by law, the Fed could require little tiny banks to keep 3% of their deposits, but the Fed doesn't. They let the board of directors decide on their own. If you're a medium-sized bank, 16.3 to 124.2, the current required reserve ratio percentage that the bank must keep of their checkable deposits is 3%, and that's as high as it could be by law. If you're a great big bank, over 124 million, then the current requirement for required reserves is 10% of your checkable deposits. It could go as low as 8%, so the Fed could decrease it, or it could go as high as 14%, so they could increase it. But currently, it's 10%. Okay, so I told you that banks don't tend to keep much money in cash at the individual bank. They also don't keep zero, so this is kind of a silly example. What would you do if you went to go get $20 out of your bank account, your bank didn't have any money. So they wouldn't actually take their account to zero, but it does make the point that banks move their cash into the bank's checking account at the Federal Reserve, which is called the bank's reserve account. So that $110,000 we had in cash has now been deposited with the Federal Reserve. We didn't make any other transaction, so we cleared out the cash account, but we increased a new asset account called the reserves account by the same amount, so we're still in balance. We're always going to be focused on calculating excess reserves. That's our goal. How much is excess reserves? We do that, though, in 3 transactions. So we're going to calculate actual reserves. Let's see here. So when we're calculating actual reserves, we're just adding together the cash account plus the reserve account. In many, even way most of your problems, the problem won't even mention a cash account. If the problem doesn't mention a cash account, then the actual reserves is only whatever they have in their reserve account. So cash plus reserves. The balance sheet that you're working problems on, the reserve account will always be given. So if they give a cash account, add it to the reserves account. If they don't give a cash account, just go with the reserves as being your actual reserves. So this is my step 1. I always look to see what's actual reserves. My step 2 then is to calculate required reserves. So required reserves is however much they give us in checkable deposits, and that figure's always given, times the required reserve ratio, and that figure's always given. So we just have to multiply it. So if your required reserve ratio here is 20% and your checkable deposits is 100,000, then if I take away that percent sign, I move the decimal 2 places to the left. So I'm going to do 100,000 times 0.2, and 100,000 times 0.2 is 20,000. Okay, so that's my required reserves right here. We did our calculation of required reserves. I didn't do that very well, did I? Okay, so now we've calculated required reserves. Your last step then is to calculate excess reserves. Your excess reserves is actual reserves minus required reserves. So remember, our actual reserves from the prior slide was 110,000. And 110,000 minus 20,000 gives us excess reserves of 90,000. You'll do this calculation a million different times before the semester is over. So we want to make sure that you understand how to calculate actual reserves, just cash plus the reserve account, required reserves, checkable deposits times the required reserve ratio, both of those numbers will be given to you, and then subtract the required from the actual to get excess reserves. Your whole interpretation of this unit is understanding that once you can calculate excess reserves, you can calculate how much the bank can loan out, because they can loan out all of their excess reserves. They have to keep their required reserves, but they can loan out excess reserves. They can also buy government securities with excess reserves. So you really can't answer any of the questions until you calculate excess reserves. Just different required reserve ratios in different countries. It's just kind of interesting to see where we fall. The higher the required reserves, the less the banking system will be able to create money. The lower the required reserves, the more money the banking system can create by loaning money out. Okay, so somebody who was a depositor in our account, remember we had 100,000 in checkable deposits, somebody's written a check. It happened to be Clem. That's right, it was Clem. Clem wanted to buy a tractor. So the tractor that Clem wanted to buy was a $50,000 tractor. And so Clem had $50,000 in his checking account here at Wahoo. So Clem writes a check for $50,000. When he does, that $50,000 is going to get subtracted from his checkable deposits, and it's going to get subtracted from the bank's reserve account. When Clem wrote a check to the tractor company, the tractor company banked at a different bank. If you read your textbook, it's called the surprise bank. So the tractor company puts that check in their checking account, so checkable deposits at surprise bank go up by $50,000. And then that check gets processed through the Federal Reserve, and the Federal Reserve takes the $50,000 out of the Wahoo Bank and gives that $50,000 in reserves to the surprise bank. The last step then is that the Wahoo Bank then subtracts the $50,000 from Clem's checking account at Wahoo. So the outcome of that, as you're looking at the slide, is that checkable deposits went down by $50,000 and reserves went down by $50,000. So I want to say that again. Whenever somebody writes a check on a certain bank here on the Wahoo Bank, checkable deposits and reserves will go down by the amount of that check. So our balance sheet has changed. So I want you to calculate excess reserves while you're looking at this balance sheet. So let's think about what actual reserves are. Do you remember? What two accounts? It was cash plus the reserve account. But we don't have cash anymore. We just have a reserve account. So our actual reserves are the $60,000 that we have in the reserve account. That's all we have. We didn't have a cash account. So then we calculate required reserves. So required reserves are this checkable deposits times the required reserve ratio. And in this chapter, they're using 20%. We saw the maximum it could be is 10, but this chapter is using 20. So 20% times 50,000, what would that be? Well, that would be 10,000. Okay. So what's excess right now? We have actual of 60. We have required of, I missed a zero, didn't I? Required of 10,000. So then excess, let's go down here a bit. Equals our $60,000 actual. I want to write a K instead of 3 zeros, but I'm afraid I'll lose somebody, so I don't. 60,000 minus 10,000. So what's our excess? Our excess equals 50,000. Oops, come down here. So how much loans could this bank make? This bank can make a $50,000 loan because they have $50,000 in excess. How much government securities could they buy? They could buy $50,000 worth of government securities. You can only invest, this bank can only make a profit with the money that they have as excess reserves, which is $50,000. So then someone comes to this bank and wants to get a loan from the bank. So that's Mr. Grisley of Grisley's Meat Packing Company. So Mr. Grisley wants to buy some meat packing equipment that cost $50,000. So how much excess reserves did we have? We had $50,000. So how much could this bank loan out? $50,000. So when Mr. Grisley asks for a $50,000 loan, does this bank have the excess reserves to support that loan? Yes, they do. So they check his credit history, whatever, decide if he's worthy of the loan, and they make him the loan. How did I tell you that a bank funds a loan that they make? I said they put it in checkable deposits. So when a bank makes a loan, it increases checkable deposits by the amount of the loan. So we had $50,000 in checkable deposits. We made a $50,000 loan, so checkable deposits are now $100,000. If we increase the liability side, we got to balance that somewhere. So we come over to the asset side and see that there's a new account created for loans. And that's where we put that $50,000. So it's an asset to the bank because it's money owed to the bank. So assets are money or assets to the bank, anything of value to the bank. A liability is money that the bank owes to someone else. So checkable deposits are a liability because the bank doesn't own that money, the depositors do. They owe that to the depositors. So that shows up on the liability side. Okay, so let's keep going. So we should calculate excess reserves again because our balance sheet has changed. So what's actual reserves? Well, we don't have a cash account, so it's 60. What's required reserves? Well, we have checkable deposits of 100. You multiply that times 20%, 20,000. Subtract it from the reserves is 60. So that's true. 60 minus the 20 is the 40,000 excess. That's true, except that Mr. Grizzly got a loan, and nobody gets a loan that they don't expect to spend. Mr. Grizzly is going to spend money out of his checking account to buy that meat packing equipment. So he got a $50,000 loan. Here it is in his checking account. But when we get to another slide, we're going to see Mr. Grizzly spent that money. So let's see what that looks like. So now we used the loan. He got a $50,000 loan. He's cashed that, meaning he's writing a check off of the increase in his checkable deposits. So checkable deposits is going to go down by the $50,000 that Mr. Grizzly paid for his meat packing equipment. What two accounts decreased when somebody cashed a check, when somebody wrote a check against this bank? Their checkable deposits goes down because it's got to come out of his checking account, right? But the bank's reserve account also goes down. So once again, when a check is written, Mr. Grizzly wrote a check off the Wahoo bank account that he has and gave it to the meat packing equipment who banks at a different account, and they deposit it. So the meat packing equipment company, their checking account goes up. The check goes through the Federal Reserve, who takes money out of Mr. Grizzly's bank's reserve account and puts it in to the meat packing company's bank's reserve account. So whenever you write a check, checkable deposits goes down by the amount of the check and reserves goes down by the amount of the check. Now calculate excess reserve again. Well, how much is our actual reserves? There's no cash account, so it's just $10,000. Here's our checkable deposits of 50. Our required reserve ratio is still 20%. So we're going to multiply the checkable deposits by the 20%. So 50,000 times 0.2 is 10,000. So required reserves is 10,000. That's required. Actual reserves is 10,000. So how much is excess then? So our excess reserves, actual is 10, required is 10. So our excess reserves are 0. That's called being all loaned up. That's a technical term, but that's what they say. All loaned up. This bank cannot make any more loans or buy any government securities. They do not have any excess reserves. They can meet their required, so they're okay. They just don't have any excess to be able to loan out. Sometimes a bank won't make loans with their excess reserves. They'll buy government securities. So if that's the case, it's the same process back a few slides ago where we calculated the excess reserves to be 50,000 before we made Mr. Grizzly a loan. Now instead of making Mr. Grizzly a loan, they decided to buy securities from a dealer. This is really odd to me because the security dealer at this bank happens to bank at the Wahoo Bank. So they bought securities from a dealer who has a checking account with Wahoo. They put the 50,000 in the security dealer's checking accounts, and then instead of adding a loan account to balance it over under asset, they add a securities account. So anytime you see the securities account, That's the value of all the government securities that this bank owns. Sometimes this bank will buy more government securities and that account will go up. Sometimes this bank will sell government securities and that will go down. So banks are always in conflicting goals. Banks are for-profit entities. They want to earn a profit. They can make loans and that will earn them interest, or they could buy government securities and that will earn them interest. There's other things they could do, but they're focused on earning a profit. But the banks have to be ever so careful because they also have to maintain enough liquidity. Remember, we defined liquid earlier. Liquid assets are assets that can be converted to cash quickly. So the bank has to maintain liquidity, and the only really liquid account that the bank has is either cash or their reserve account. So they have to keep enough in their reserve account to meet all their depositors' demands. So if they get greedy and they try to loan out too much, then the bank can fail, can go under, because they can't meet their depositors' demands. So banks are constantly balancing these conflicting goals. If a bank finds that it cannot meet the required reserves, so we calculated that required reserves, in our example it was 100,000 times 0.2, 20,000. If we didn't have the amount in reserves, that required reserves that the Federal Reserve says we must, then we have to deal with it that very day. We can get an overnight loan from another bank. If we get an overnight loan from another bank, then the interest rate we pay is the federal funds rate. That's bank to bank. So if there's another bank that we have a partnership kind of agreement with, then they might loan us some of their excess reserves because we're going to pay it back with interest. So that's a way for them to make some money, even in just an overnight loan. So if we do get a loan from another bank, the interest rate will be called the federal funds rate. But what did we say about the Federal Reserve? We said the Federal Reserve was the lender of last resort. I don't want to be way over there. I'm going to come over here. So if we get an interest rate from a loan from the Federal Reserve, the interest rate we pay is going to be called the discount rate, which is a really interesting term because it's actually a higher rate than the federal funds rate. So it seems a little oxymoronish to me. So I'm going to say this one more time. If the bank can't meet their required reserves, they'll get an overnight loan. They want to get it from another bank. So if they borrow from another bank, the interest rate's called the federal funds rate. If there aren't any banks that they have relationships with that they can borrow from, then they will have to go to the Federal Reserve to get their loan. And if the Federal Reserve makes them the loan, the interest rate's called the discount rate. So we have been looking at a single bank so far. We're going to up the ante here. We're going to move from a single bank to the entire banking system. We're going to walk through this model. What you're going to see is when money comes out of one person's bank, it ends up going into another person's bank, and when they spend it, it goes to another bank, and when they spend it, it ends up being deposited to another bank. You've probably realized this, you've just never put it in words before. So we have to look at the entire banking system. When a single bank loans money, it creates the amount of money that the loan was for. So if they make a $50,000 loan, that single bank has created $50,000. Mr. Grizzly got to go spend that money. Nobody else's account went down by $50,000. The bank put an electronic transaction of $50,000 in Mr. Grizzly's account, and Mr. Grizzly went out on his merry way to spend that money, bought the meat packing equipment. So a single bank can create the amount of money that they can loan out. But if you think about the entire banking system, every time somebody makes a loan and the money gets spent, it gets deposited somewhere. And so that gives them more excess reserves. So they can make more loans and it can go into somebody's checking account and get spent and get deposited somewhere and increase excess reserves and gets loaned out and spent again. That's what we're going to look at next. So it's kind of a complicated chart, and I get that, but you'll get the general idea. So there's been this new influx of money. You can think of somebody finding a $100 bill in the couch or something, and they deposit that $100. Well, if the required reserve ratio is 20%, then the bank must keep 20% as required reserves of that $100, but that gives them excess reserves that they could loan out. If 80 is just too small for you to think about a loan, just keep saying 80 million or something. You'll get the general idea. So this bank can loan out 80 million because that's the increase in excess reserves they had. And they do. Say they loan it out and it gets spent. And wherever it gets spent, let's say they bank at Bank B. And so they spent $80, so Bank B gets an increase in their reserves of $80. The person put it in that checking account. That made the required reserves for that checking account, that bank's checkable deposits, go up by 20% of $80, which is 16. So required reserves on that $80 deposit is 16. The rest of it is excess. So this bank can loan out $64, 64 million if you will. They loan that out and it gets spent and it gets deposited into Bank C. And so Bank C gets that deposit of 64 in the checkable deposits and in their reserve account. And so 20% of that gets held as required, so that's $12.80. You subtract that from what got deposited of 64, and so their excess reserved went up by 51.20, 51.2. And so they could make that loan, and they do, and it gets spent, and it gets deposited into the next bank. It just keeps going. And we're going to find out that initial deposit of $100 that had that initial excess reserves of 80 is going to grow to $400. And there's an easier way to figure that out than to create this chart. We need to look at the money multiplier. So the money multiplier is 1 divided by the required reserve ratio. So the money multiplier is 1 divided by 0.2 in this example, which is 5. You multiply that times the initial excess reserves, 5 times 80. We knew that we were going to be able to create $400 new dollars. This just puts it in a different format. So this is our money multiplier. We know it's 1 divided by the required reserve ratio. So in our example here in this book, we just said it's 1 divided by 0.2. And 1 divided by 0.2 is 5. Okay? So when we deposited that $100, $20 of it was required reserves because 100 times 0.2 is 20. The rest is excess reserves. And the excess reserves, not the whole deposit, the excess reserves gets multiplied by the money multiplier. So 80 times 5 means that we're going to be able to create $400 more dollars. So when you think about the money creating potential, that's the way your problems will ask it. What's the money creating potential? I want you to use that formula. Let's see, maximum money creating potential. Boy, that's a lot to write, isn't it? Let's see, maximum amount of money created. I think I'll stop there. No, you'll wish I had said creating potential because that's how your problems are phrased. Creating potential. It's more fun when you abbreviate, but you get words you might not have meant to use. All right, maximum money creating potential. That's going to be our money multiplier we just calculated up here. Our money multiplier times our initial excess reserves. That's that first line. You know, in that chart before, there were a bajillion lines with excess reserves, but we just multiplied times the initial excess reserves. So in ours, that was a money multiplier of 4 and initial excess reserves of 5. I don't know why I said 4. A money multiplier of 5 times that initial excess reserves of 80 to give that money creating potential of 400. In the examples we were working, our required reserve ratio was 20%. Our money multiplier, 1 divided by the required reserve ratio, so 1 divided by 0.2, that money multiplier was 5. If we increased the required reserve ratio, if the Federal Reserve said instead of holding 20, you're going to hold 25%, which is not true in the real world, but if that's the way it was in the problem, then the money multiplier would be 1 divided by 0.25, which is 4. So if we keep increasing the required reserve ratio, the multiplier will go down, so will the excess reserves, and so will the money creating potential. I want you to begin to think about it is the banks that are creating money when they make these loans, literally creating money. We tend to think, no, that's the Mint when they print money and the Federal Reserve when they issue it. Okay, that could happen that way, but it's not how it does happen in the real world for the vast majority. Banks create money when they make loans, but that's reversible because when the loan is repaid, it destroys money. Remember, the only two things in M1 money is currency and checkable deposits. So when a person gets a loan, their checkable deposits goes up. That created money. But when a person repays a loan, that money comes out of their checking account, goes back into the bank. Hear my sentence. Money held inside of a bank or any government institution is not counted in the money supply. So when money comes out of that checking account and goes into the bank, that money is destroyed. The money supply literally decreases because the only two things we're counting in M1 money is money in our pockets, our currency, and money in our checking account. So you're going to work a million problems that ask you how much can this bank loan out? Calculate excess reserves. That ask you how much can this bank create money? However much their excess reserves is, because that's how much they can loan out. Until you get to the entire banking system, read your problems carefully. If they name a bank, Serenity Bank, Wahoo Bank, if they name a bank, that's one bank. So they can only create the amount of their excess reserves. But if they talk about the entire banking system, they're not naming a certain bank, but all banks. Sometimes they'll say consolidated banking system. Now I have to use the money multiplier and multiply that against the initial excess reserves to see what the money creating potential is. Please spend some time, go back through as much as you need, work these problems carefully and slowly. Post your questions in the discussion board because it's going to all be applied in the next chapter. So we need to catch this one.